Hey, it's Connie from Prosperity Finance. I hope you're well. In this video, I'm going to give you updates for the current interest rate environment and just share some my opinion about the interest rate trend and also give you some tips what you need to do in the current situation. So let's start. Firstly, what's current interest rate environments? Well, if we're talking about Chinese bank, you probably heard recently that all three Chinese banks, they are offering really attractive rates. So for example, Bank of China is offering 3.15% rates for both 1 year and 2 years, right? So they are much cheaper than the mainstream banks. But, you know, when you consider a home loan, it's not just about the rates. So there's other more important stuff, including repayment structure, loan structure, product, etc. But if we're just talking about rates, they are 0.3 or 0.4% cheaper than the mainstream banks. So when we talk about Australian banks, so ANZ, ASB, BNZ, Westpac, so their lowest rates at the moment is 2 year, so around 3.49%, and the 1 year rate is at 3.55%. And even 5 year term is also within 4%, currently at 3.99%. So it's kind of a historical low. Most people still go with the 1 year rates. It's simply because most people expect the rates will keep going down in the next, few months. So, it's easier to adjust when you lock in a shorter term. But why not 6 months? 6 months is still more expensive than the 1 year rates. So if you work out the weighted average, probably still better off to go with the 1 year. However, if you have investment property loan, just bear in mind some banks actually charge higher rates. For example, BNZ, so they're offering about between 0.25% to 0.3% higher for investment property loan than owner-occupied loan. So just bear in mind it's actually different pricing. That's purely because the bank has to hold higher capital for investment property loan. It's actually across all the banks, but some banks choose to pass on that additional cost to borrowers. Some keeps the same so that they stay attractive. Okay, so we notice BNZ does that and SBS Bank does that as well. We notice Westpac has a slightly increase for investment property, not as much as BNZ, like 0.3%, but it could be just a timing thing. Other bank, ASB and ANZ might follow as well in the future. So just let you know, not all the loan can get that kind of a low rate. Okay, what is the trend? So a lot of economists predicts the OCR is going to be dropped to 0.25% by May next year. So currently it's sitting at a 1%. So the drop is around 0.75%. All right. So what does that mean to us? Does that mean over interest rates we've been charged by the bank also dropped by the same amount? Well, it's $1 million question. There's two reasons that the bank may not pass that kind of a big drop. Number one is because the bank always have to keep a certain margin, and over the last decade, bank has to keep minimum 2% margin. So like even the OCR is only 0.25%, they still have to charge over 2% rates just to keep that margin. Okay, because they are a profitable organization, right, at the end of the day. So that's one reason. And the second reason is you probably heard a lot of news about talking about capital adequacy. Now, just give you an idea, at the moment, on average, the Aussie bank has to hold about 8% of loan as capital. So that's to absorb any losses in the economic downturn, right? But the local bank, for example, Kiwi Bank, has to hold up to 15%. So it's almost doubled, right? So it's not really fair in a way because the more capital you hold, yes, it's safer. However, it costs them more to the bank because they don't get return for the capital money, right? So the banks, or the Aussie bank, are still kind of negotiating with Reserve Bank and see what is the right level is. Now, if there's a significant increase in the capital adequacy requirements, then even the OCR do drop quite significantly. It doesn't really mean, that the actual interest rate would drop. So it depends, how much drop, how much increase. All right. So just be in mind. So what's going to happen for the next few months. So that's about the trend. So we still recommend locking 1 year because still the big picture, the rates looks like it's going to keep dropping. It's just a matter of by how much, right? Now there's a few reasons you need to bear in mind that not the cheapest is always the best. So number one is people need to consider certainty. If you are expecting your household income decrease over the next year or two, for example, you may have two income earners at the moment, but maybe your partner is going to be on maternity leave soon, so that's going to be just one income for a little while, and you have a newborn, so that actually costs you more. So it just make sure you give yourself some breathing space, don't stress yourself too much. Some other scenario, like you probably going to, start up a business from a salary, so you might have some uncertainty over your cash flow, or maybe you expect your health is unwell, so it's all affect your income, affect your cash flow. So if you do have that kind of expectation, please at least put some loan onto a longer term so that you can have a peace of mind. Now, the number 2 tips is that if your loan is coming out fixed term soon, yes, you probably automatically paying less rates, but it's best to keep the same payment so that more of your money is going towards the principal reduction. That can save you a lot of interest costs in the long run. Okay, so that's a number 2. Number 3, you may consider borrow more. Given interest rates so low, your rent income potentially would cover the mortgage payments. So some people thinking about borrowing more. Now, if your loan borrowing capacity is not big enough to purchase another property, don't worry too much. What we see is that in Australia, they have dropped the assessment interest rate. That means people with the same level of income can borrow more. Okay, so New Zealand Bank, they will follow that. It's just a matter of time, because every time they change something, there's a lot of flow on effect, so they make sure everything is ready. So it's just a matter of timing. Okay, so if you can't, borrow, enough to buy a property, it could happen in the next few months. Okay. So at the moment, New Zealand Bank still charge kind of on average 7% assessment rates. But in reality, you are paying like as low as 3.15. So it's a big difference. So they are about to adjust that. The next tips is about doing break fee analysis. It's very useful for people who already have existing loan. It's still on fixed term, and you regret that you fixed for so long because you will miss the lower rates. So if you are thinking about break your loan, talk to us, because we'll do free break fee analysis. Will help you to consider factoring all the costs and all the reward, even including the possibility of refinancing, so we can help you to see through, help you make a decision. Is it better to stay on the current loan term or break it or even refinance? So we can do all that for you for free. Okay. Finally, is that I would say this is the best time to review your loan. Okay, so you may not consider buying more, but current loan structure is critical, and that will have impact on your further borrowing capacity. So even you're not considering borrow more at the moment, but it will be really good to consolidate, review your loan and make sure when you're ready to buy more, your structure actually work for you. Okay, because sometimes, for example, you have everything with one bank, you can't unlock the equity, you can't borrow more, or you probably kind of prone to the higher interest rates when it comes out fixed term, etc. There's a lot of things you might consider when you do the loan review. So the best way to do is contact us. We'll do everything for free for you, even you don't do anything in the end. I hope you find this video is useful. If you know your family, friends would benefit from this, please feel free to share this video with them. Thank you so much for watching. I will see you next time. Bye for now.